Hey investor friends, I'm Michelle Markey, and today I want to talk about my investing journey from when I was in my earlier 20s and trying to figure out personal finance and how to invest, and what I've done over the last 8 years after having been influenced in reading the 2009 I Will Teach You to Be Rich by Ramit Sethi. And I actually read the updated edition that came out in 2019 to judge things that I've learned and how I've gone on my own path with some of the ideas that Ramit has covered in this book. And I'm happy to talk about things that I think are helpful and things which I don't know if they make a huge difference, and also things that I disagreed with from this book. Back in 2012, it hadn't been long since I'd graduated from undergraduate college, and I was trying to pay off student loans while figuring out how to save money and invest for my future. And I borrowed a bunch of finance and investing books from the library and had things like Intelligent Investor by Benjamin Graham, which was a little bit too much for me at the time. And then I came across this book, I Will Teach You to Be Rich by Ramit Sethi, and I thought this was pretty easy to stomach. Like, when you're trying to first figure out a lot of your personal finances and you haven't really done that much yet in terms of retirement savings, then it's a little bit daunting at first to try to wrap one's head around paying off student loans and getting started on retirement savings. And according to Ramit, not a lot of people below age 35 think about saving for retirement, but that was certainly top of mind for me in my earlier 20s, and I've opened a Roth IRA when I was 18. So to me, I was always looking forward to trying to save money for retirement, and I know that's not very typical from young people, but I didn't know how back then. So I was glad to come across this book that helps get me started on a path towards financial freedom. And Ramit even mentions the FIRE path, financial independence, retiring early movement, and has some comments about it. But I'm going to focus on some of my key takeaways and some of my key areas where I differ on my strategy and tactics. Ramit opens his book by asking, would you rather be sexy or rich? And the context of this question is some people like to brag about the latest stock that they've bought or shorted, or cryptocurrencies that they've traded, and some of that doesn't lend itself to sustainable investing for the long term. In comparison, Ramit likes a boring investing strategy that is more likely to make people rich by just buying index funds and holding them for the long term. So in his mind, he'd rather be rich than someone who might be considered sexy for having cryptocurrencies or whatever the latest bubble is in trading. And in that way, he thinks that you can become rich by investing in something like I just said, index funds, which at a 7 to 8%, if you reflect the American stock market over the last century or so, that's an okay rate that you could grow your investments at, 7 to 8% per year. And in my mind, it's a little bit mediocre. I'd rather aim for 10 to 15% per year on a more consistent basis by investing in stocks. But for people who don't want to put too much effort into researching which stocks to invest, they would go for an option like index funds, which is what I did back in the mid 2010s. I first invested in index funds, and it worked out okay. I actually did perform close to what Ramit mentioned at the 7 to 8% per year compounded growth rate. And over time, while I'd been invested in index funds, I grew over the course of about 5 to 6 years, a cumulative amount of about 48%. So in some ways, I kind of doubled my money after you also account for some of my contributions over some of that period of time. But I've kind of moved on from index investing. That's no longer my preferred way to invest if I can help it. In a 401k, I don't have much of a choice, so I have to do that. And even then, Ramit and I both agreed that we should have expense ratios below 0.75%. I mean, for me, I'd rather have like 0.03% if I can help it in an expense ratio if I had to get an index fund. But he goes into much more detail about why investing in index funds and also doing it on an automated dollar cost average, keep investing kind of way is how he prefers to go. And I'd rather be a little bit more nuanced and put more work into my investing strategy. And who's to say you can't be both sexy and rich? I'd rather try to be both if I can help it. But also, I want to say that even with investing in the way that Ramit does, there's nothing fundamentally wrong with doing that. It's pretty okay. Index funds have been generally reliable over the last 50 years or so when they became available in the early 70s, and over time they've gotten a lot of popularity. But some of the areas that make me feel a little bit uncomfortable is the idea that me and a bunch of other unknown people across the country are investing in just index funds that are in diverse stocks and across various industries, which some people argue can be helpful. It's could be useful to be diversified across some assets and different industries. But if you're so diversified that you don't know exactly what you're investing in, to me that kind of makes me scared, because what if I'm investing in companies that I don't believe in, or whose performance I can't really measure and judge as to if I agree with where that company is going into the future. So both index funds and after that I also invest in ETFs before. So both of those kinds of things draw from similar ideas of investing in baskets of various stocks or other kinds of assets, and it just isn't, in my mind, a comfortable way to know what I'm investing in. So I'd rather not just keep contributing blindly to it, because it's a way for a lot of sheep to fall off a cliff. And what I mean by that is we have so many people putting their retirement savings in index funds all across the country, and all these people don't really know what they're invested in, if I had to take a guess. And I'd rather just not be subject to the market just bringing down all of my investments all at the same time with everybody else. So I'd rather invest in individual companies whose future I believe in and can measure and can judge the valuation that I'm comfortable investing in them. And the other thing is, Ramit likes to dollar cost average, continue putting in money and maxing out your 401k for reasons like I just described. That makes me feel a little bit uncomfortable, because I kind of feel like my 401k or other retirement accounts could be held hostage by being in index funds. And if you also invest in something like real estate investment funds, sometimes those things are not the most liquid and investors can have difficulty getting out. So just because these are index funds and ETFs and they're generally liquid, it doesn't mean that they're always liquid and that you could always get out of them. So just be careful if you're taking this approach. And like Ramit says, you should rebalance your allocations every now and then. That might be something you want to think about if you are going to invest in this kind of diversified account, but it's not my favorite. And I also don't think that just blindly dollar cost averaging, so that means contributing a consistent amount all the time, is my favorite thing to do. He's a big proponent of a system of automated investing where you automatically contribute to your accounts as well as you automatically pay off any bills you have from your checking accounts. And that's okay for some people if you want to have an automated system and not have to live in a spreadsheet like he says. And I kind of live in a spreadsheet, so I'll fully admit that I like having the most amount of control by overseeing to the penny all of my investments and savings and expenses and paying my bills. So I don't completely automate my spending and savings like Ramit does, but to each their own. So if it works for you, he has a lot of great suggestions for how you can create your own automated system. Ramit gives generally agreeable advice about personal finance and paying off debt or credit cards or other loans and investing. But one thing that I definitely disagree with him on is he thinks that mom and pop investors or everyday retail investors like you and I have no chance of competing with the so-called professionals of Wall Street or legendary investors like Warren Buffett or David Swensen of Yale in consistently beating the market. And I'd like to say that I think that that's incorrect. I think that people can beat the market. They may not always do it consistently, but it's still possible for people to beat the market sometimes. And that's kind of how investing goes. Not even Warren Buffett or David Swensen beat the market at all times, even though they've had a pretty great positive compounded annual growth rate year in and year out. But that doesn't mean that there isn't hope for the everyday investors. So I want to not be so deterministic like Ramit is in saying that, and I want to give reassurance to people that we can beat the professionals, at least sometimes, because professionals have different motivations. They're under specific deadlines and performance targets that they need to generate some level of return over a certain amount of time. But everyday investors aren't under that kind of pressure. We have time to invest for the long term, like 40, 50, 80 years if we want. And by having that kind of long-term investing, we can afford to invest in individual companies and also sell them if we don't think they're good investments anymore. We're not under pressure of professional money managers having to perform at a certain amount every year or by quarter. Also, money managers have different values than us. So they might be actively managing mutual funds, which Ramit and I agree we try to stay away from. And if you had to choose, do index funds rather than an actively managed mutual fund. But because these money managers have different values from everyday investors, we can choose what companies we want to invest in rather than maybe just relying that a professional is investing in your behalf. So unless they're a fiduciary, they're required to be responsible and invest in your best interest. But if they're not a fiduciary, and if you're just investing in some actively managed fund, I'd be careful and definitely do your best to study if you think that this is a professional money manager that you would want to invest with. In Ramit's 6-week program, he spends a lot of the beginning of the book focusing on credit cards and debt and banks. And I generally agree with a lot of what he says here. And even back in 2012 or so, I followed his advice and opened an online savings or money market account. And that definitely helped to generate some more interest than what I would have at a typical brick and mortar bank. Although brick and mortar banks are not terrible either. You can use them for certain purposes as well, in addition to the online banks. Like Charles Schwab are both heavily online and have a few brick and mortar locations, but they're useful for investment accounts and high yield free checking accounts, or also zero fees on ATM machines all over the world, so you get reimbursed if you use them in faraway countries like Peru. So that's pretty awesome, because having zero fees is something that I agree entirely with Ramit. So trying to reduce fees on anything you have, whether it's your checking accounts, your credit cards, any kind of account you have, reducing fees is so key. That's how a lot of people get into trouble. And Ramit spends a lot of time, a little bit more than I would expect, on things like overdraft fees. Like, I would just nip that in the bud by telling your bank to not allow any charges to go through on your debit card and allow your bank to get overdrafted. Like, why would anyone let that happen and then have to pay $35 or more in an overdraft fee? And I would just not let it happen to begin with. Although Ramit is against department store credit cards, I actually think that they're a useful way to get started in building your credit score and also your credit history, so that you can become an excellent person to lend to in the long term. So, for example, when I was in my late teens, I piggybacked off of my parents' credit card to open my own at a department store, and that was a small way to get started in using credit cards so I could build my credit score. And eventually I got my own real credit cards, and nowadays, after reading reviews on places like NerdWallet, I've gotten some travel and or cashback reward cards, and those are my favorite. The only one I spend annual fees on is the travel rewards card with an airline that I usually fly with, but that's the one that I'm comfortable spending annual fees on. Some might be willing to spend those annual fees on credit cards that give bigger rewards, but you're expected to spend a lot more on some of them. So I'd be careful about the amount of rewards you're getting versus how much you're paying in annual fees. Like, I'm okay with getting cash back on 0-fee cards. That's a pretty good deal. And otherwise, I would just use credit cards so that you don't have to kind of waste using cash. Like, you actually get a benefit. Like, imagine getting 5% back on gasoline. I think that's pretty sweet. Like, my dollar technically stretches further by getting 5% back on gas expenses when it's maybe that reward quarter that is available. But either way, if you want to build your credit score, utilizing credit cards responsibly is helpful so that eventually when you want to get a mortgage, you've built up a long history of responsible, reliable credit card usage and other kinds of loans. Your credit score is also built on loans like from cars or student loans or mortgages. So all of this goes into your credit history, and a lot of banks actually allow you to check this. I know Ramit mentions you can pay for it, or you can also go to Credit Karma or Credit Sesame. There's so many places that let you check your credit score, also known as FICO score, or also your credit history. But I would just use whatever is like the most free. There are ways that you can check your credit score for free from reputable sources. I don't feel the need to pay for that. And also, your credit score is based on how reliably you've paid, how old is your oldest credit card account, and other factors like your utilization rate. Like, if you have $10,000 of a spending limit, are you always close to maxing that out? So are you at like 9,000 out of 10,000 on your credit limit? That would be a high utilization rate, which would be kind of bad. So if you can get that lower to like maybe only having a $200 on a $10,000 limit, that would be more optimal because it shows that you're not as at risk of defaulting on your loans in that credit card. Ramit likes to say, focus on 5 to 10 big wins, which are some of your biggest expenses that can have a disproportionate effect on your bottom line. So for example, things like student loans, credit card debt, other kinds of expenses you have, focus on the bigger ones as opposed to the smaller ones like coffee and lattes. And if you can do that by, for example, student loans, some people are very nervous about continuing to have a loan balance, so they want to pay off student loans and credit card loans as soon as possible. That's also the mindset I had, but I had a little bit of a hybrid approach like Ramit talks about, where I paid off my student loans as soon as I could while also starting to grow my retirement savings with my 401k that I got the minimum to get a match, as well as in my Roth, I contributed some money per year in my earlier 20s. I didn't always get to contribute the full amount because I didn't always have that money to contribute it, but I tried to do what I could while still prioritizing paying off my student loans as soon as I could. So within a few years of graduating undergrad, I paid off undergrad loans, and then within a year of finishing grad school, I also paid off those loans. So that was a huge accomplishment to me, but I also took advantage of the tax advantages of a Roth IRA and also compounding some of what I had been invested in at the time. And luckily, the markets were generally going up in the mid-2010s. I mean, they've kind of been going up since 2009 through even 2020. So we've been super lucky to be in a bull market for almost like 11, 12 years. And who knows when the musical chairs game will stop and markets go down. But so far, we've been pretty fortunate throughout this time to be able to grow our money in Roth and 401k accounts. So I feel pretty fortunate that I was able to pay off my student loans and grow some of my retirement savings. And I generally agree with Ramit on trying to strive for those things. I don't max out my 401k, but that doesn't mean other people can't do it. And then the one thing that he emphasized that I thought was a really good idea is investing in a health savings account. And I learned about this from other sources and even in the past, but I got it a little bit confused with a flexible spending account where you lose your money if you don't use it. So I just thought all these health savings things were not that great until I realized, and Ramit's book reinforced, the power of an HSA, where you can save for retirement. And if you check out one of my videos, feel free to learn more about HSAs and how amazing they are and how you can use them for not just qualified medical expenses, but after age 65, you can also use it in retirement for whatever and just pay income taxes on it. So definitely consider a health savings account if you're eligible for it. And otherwise, Ramit gives pretty solid advice on a personal finance ladder that I think a lot of people will do well to benefit from. He goes on to talk about a conscious spending plan, which to me suspiciously sounds like a budget. And I think psychologically, he's trying to convince people to use this conscious spending plan where he suggests an 85% solution is saving about 10 to 20% for retirement and various savings. And a 60% solution is one where you have 40% savings and investments across long-term, short-term savings and retirement accounts, and then fund money to kind of gamble with and invest in the stock market. Like he considers when he was younger, investing $11,000 to grow to $298,000 in Amazon stock to be kind of like fun money and kind of gambling, which he doesn't recommend to a lot of people investing in individual stocks because he got lucky. And although that's true, you can be lucky and have no idea if a company is going to make it. If you do study and learn about a company, that could have been a great investment for someone who had studied, and it may not have been as lucky as it seemed at the time. And then also, I remember him railing against real estate in his first book. And real estate, although it goes up nominally in value, realistically in actual dollar terms, it may not have gone up necessarily that much over time because of inflation. So I remember that being a salient point because a lot of people talk about real estate being a great investment when it's not always. Markets for real estate, like in New York City right now with the coronavirus, people don't want to be holding on to some of those investments because what they would sell it for now could actually be less because a lot of people have migrated out to the suburbs to get a little bit more space during this pandemic. So the irony is real estate isn't always the best kind of investment either, and I kind of agree. So take your time and also study the facts. Like he goes into details about investing in real estate if you really want to commit to buying your first house, and what are some of the expenses you can expect, like 40 to 50% more of expenses across everything, like maintenance and mortgage and taxes and insurance for having a house as opposed to just renting. Something that he's expanded on when it comes to being in relationships and working towards a marriage. And I like how he says marriage is a team, but he said to his spouse that a prenup is important to him because he was the one coming into the relationship with a lot more wealth and assets, and he wanted those protected because, as we all know, the dim reality is a lot of people can get divorced in the US, and it's a little bit ugly. So although it's a difficult process going through a prenup or a prenuptial agreement to protect your assets, it's something that I would do. I think that it's important that any assets that we've built up individually is helpful to protect no matter what happens, as much as you might love your spouse. And if your spouse understands, they can also benefit by also having their assets protected. So it's just something to keep in mind, as well as he goes into detail about saving towards a wedding. Like an average American wedding is $35,000, and also paying off your debt can also cost the average American $35,000. So conveniently, that's like $70,000 right there. One of the last things I want to mention is Ramit says that a lot of people have their invisible money scripts, and some of this comes from their parents. That can have a big influence in your attitudes and behaviors towards investing and your personal finances. And I feel fortunate that my parents have always been transparent with me. They even brought me in some of their mortgage refinancing meetings when I was like 13. So I think it's kind of funny that I've been influenced to try to be very mindful about spending and finance. But no matter what your personal invisible money script is, there's always opportunity to change and make it better. And I actually think that if you read this book, you'll actually appreciate the advice that Ramit is giving, and it can affirm some of your behaviors you're already doing, or it can help you navigate to a path. Like if you are shy and calling people, he gives scripts for calling a credit card company to negotiate something. So that could be pretty useful, or negotiating for a raise at work. And I think that that can help everybody, whether you're financially doing pretty okay or you're still in the beginning and want to go through this journey to improve your situation. So if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey towards financial freedom. Till next time.